Good afternoon, everyone. Thanks for joining this 2023 job market update. My name is Alexey Gutin, and I am going to run through a little bit of what we're seeing in the market last year and what we think we're going to see this year. Just a couple housekeeping items before we start. This webinar is recorded, and we'll send you a recording afterwards in case you can't make the whole thing. And if you have any questions along the way, please feel free to use the Q&A button and send us a message, and I'll try to do my best to answer it at the end. And yeah, if anyone has any questions, feel free to shoot them in the message or reach out to me directly after this webinar. So the agenda I have for today is to kind of give a quick overview of what I see, at least in our industry, of association partners that we work with, of what the current state of the labor and the job market are. I'm going to try to do a deep dive into what I'm seeing on job seeker trends and behaviors, and what association members are doing and how they're behaving differently than prior years. And then a little bit on current and future hiring outlooks on a few of the different industries that we primarily partner with our associations on, or at least a good portion of them, not all of them. And then a few predictions for 2023, at least the first half, because it is very confusing out there. And I guess that's where I wanted to start, is to kind of talk a little bit about what's happened since COVID and for the last couple of years. And it's been a kind of a crazy labor market over the last couple of years. So in 2020, when COVID hit, it really impacted the labor market. There was really high unemployment that I'll touch on later. But that recovery from that dip was very quick. And so 2021 was an extremely hot labor market. We had job postings that were up almost 100% year over year in many industries. Overall, it was up something like 80% from 2020. Unemployment, spiked in 2020, but in 21 dropped down really rapidly, ending at under 4%. And there was a big disconnect at the end of 2021 between the number of employers and the number of open jobs and the number of people looking. And in many ways, 2022 last year was not much different. It continued to be a hot labor market. It continued to be a job seekers market. The Great Resignation that started in 21 continued into part of 22. And overall, if you look at job posting volume, last year, it dipped a little bit across all jobs prior to 2021, but I'll try to give you some visual context at what that means. We're still, I would say, at historic levels of competitiveness for talent. So there was a dip, and if you average that out across all the industries, but certain industries are doing much better. Certain industries maybe have been affected by layoffs. So I'll try to dive into that later in this conversation. And then the other notable thing that is throwing the biggest question mark, and why I said the market is weird, is inflation. And so the monetary policies being used to combat inflation have a very kind of uncertain outcome of how that's going to affect the labor markets. And so that's kind of the last 2 years what we've been seeing at a very, very high level. If you look to take a step back and kind of walk through it in a little bit more detail, if you look at employment levels pre-COVID, we were at a pretty high employment levels. That dropped very rapidly during COVID and has come back gradually. And it took a long time to come back, much slower than, for example, the unemployment rate recovery. And so we're finally back to pre-COVID levels, a little bit higher actually, but it took a long time. It was well into last year that it took to recover back to pre-COVID, early 22 or early 2020 levels. So that part of the recovery is nice to see. But what hasn't recovered is the prime age labor force participation rate. So both of these graphs that I just showed come from the Bureau of Labor Statistics. This is released every single month. And so the labor force participation dropped very rapidly during COVID and did not recover very quickly. And it still has, in fact, it still hasn't recovered. It's trending, up and to the right just slowly, but it hasn't recovered into the pre-COVID levels. And the prime age labor force participation rate is defined as people working between the ages of 25 and 55. And it's been trending up, but in last year in September, October, and November, it dropped very significantly over that 3-month period, only to tick back up into December. That data was just released. So the jury is very much still out on what's going to happen in terms of the labor participation rate this year. So this is one component of why employers are having a hard time hiring. There is people outside, this pool, this 30-year window of workers that's coming into the workforce. There's certainly younger people, but there's also people that had retired maybe a little bit earlier. Are now coming back into the workforce. That's alleviating some of this pain. So some people that maybe retired at age 60 decided with inflation that their nest egg wasn't going to go as far as they thought, and they decided to come back and re-enter the workforce. That's helping some of this for employers, but still the labor participation rate is still lower than it has been over the last few years, and it hasn't come back to pre-COVID levels. Meaning it still remains to be a competitive hiring environment for employers to find good talent. And in terms of unemployment rate, we had this historic spike in unemployment over, nearly overnight when businesses shut down during COVID. But we had an equally fast recovery where unemployment came back very, very quickly. Nearly all of 2021, it was low, ended at under 4%. And all of last year, unemployment was more or less steady. It was very, very low and ended at, I think, historically low levels of 3.5%. So again, if someone wants to be employed currently, chances are that they can find a job reasonably quickly and reasonably easily, given that employers are hiring still at pretty historically high levels. In terms of job openings, and I'm going to go into maybe some data from other job boards as well, but I'll continue on this track for now of using data from the Bureau of Labor Statistics. Job openings are, I wanted to show a visual of kind of where we are today. They're at historically high levels, the highest levels we've seen in several decades. And even before the pandemic, you could see that the number of job openings was ticking up. And pre-pandemic, we very much thought we were in this really competitive hiring environment. There was very much a war for talent. And then the pandemic hit, and there was this temporary drop in jobs, but it recovered really quickly, and it recovered in a very, very meaningful way and very rapidly. And so pre-COVID, job openings were, I think, around 7 million or so, 7.5, and today we're, I think something like 10 million open jobs. And so that growth in job openings spiked up really quickly. It resulted in 2021 being an incredibly competitive year for hiring for employers, and that continued into last year. Last year, we saw that growth of job openings start to slow down, and in fact to decelerate. But that number of that pullback was pretty minor. It was a relatively small percentage, and so we're still at really, really high levels of the number of open jobs, especially compared to how many people are looking. With unemployment being really low, there's still a really big disconnect and a really big supply and demand gap, supply being the number of job seekers out there and demand being the number of job openings that employers are looking to fill. And on top of all that, so everything I've been saying so far implies that things should be great in terms of it's very much a job seekers market, and everything should be continuing as is, and that there's no imminent or nothing in the horizon that would forecast any kind of cloudy weather. But that's not true. That's not totally true. At the beginning of last year, and maybe even at the end of 2021, inflation started to spike up, and in order to combat that, the Federal Reserve started increasing interest rates, and doing so with the intent of increasing unemployment to tamp down inflation, because they were seeing wage growth happening very quickly, as well as the cost of goods and services going up. So to tamp that down, they increased the cost of borrowing, of cost of debt, to try to tamp down inflation, and to intentionally increase unemployment, with, I think, the goal that they had stated was, they're looking to have unemployment be in the 4 to 4.5% range sometime this year. And so that was, the concern with the rising interest rates was that it would have a nearly immediate impact on unemployment, that job postings would start to get pulled back. And that has happened in a relatively small pocket of industries and professions. But I would say that has not happened across the board. We still have most industries that are hiring at very high levels, maybe a little bit lower or the same as last year. So maybe the job posting growth slowed down year over year, and stopped growing, but hasn't materially declined in most of the industries that we operate in, compared to 21. But this is certainly something to watch, and a lot of economists are predicting that this will eventually cause a recession, and it's just a matter of how severe that recession will be, and a matter of how much it will raise unemployment. And on top of all that, and kind of these mixed signals and all this uncertainty from there being a labor shortage to potentially higher unemployment through monetary policy. The other component of that is the job seeker behavior that we've been seeing over the last couple of years. So with this kind of new power and new demand, job seekers started looking around and reevaluating if their current work situation is the best one for their career. And for a good part of 2021, everyone heard of the great resignation, where job seekers were quite easily finding new opportunities with either better pay or flexible or hybrid or work from home opportunities or better benefits, whatever it may be. We started seeing record levels, historically high levels of resignations. And so the Bureau of Labor Statistics started reporting that. I think towards the middle or end of 2021, we peaked at the highest levels, incredibly high levels of resignations. It was hard to retain talent, hard to replace it, let alone add net new talent to your team. And that continued into part of last year. But in the back half of last year, we started seeing job seekers pull that back a little bit. So it's still high. It still continues to be quite elevated and higher than historical averages, a lot higher. But many job seekers that were jumping before are now, thinking twice and thinking maybe that the situation they're currently in is a better bet, just due to economic uncertainty. A lot of the companies that people were moving to, especially in the tech world, were offering extremely attractive financial packages and benefits, and with the interest rates being higher and venture capital and private equity funding slowing down, those companies are now the ones laying many of the tech workers off. And so a lot of this has started to pull back in the back half of last year, and I think this resignation trend will continue to kind of normalize and come back to normal levels this year, as people start to stay put and and reevaluate if it really is worth making a change and potentially taking a risk of the new company they're joining not being as stable as the one they're with today. And from a job seeker perspective of like seeker searches, I think one of the easiest trends to look at globally is to use Google. And most job seekers start their search on Google and start typing in their search terms. So I decided to use a tool that Google has called Google Trends, where it lets you keep track of patterns. They're all relative to each other of how many job searches are candidates performing on Google per week. And so I plotted this, and it's hard to create any kind of pattern out of this. This looks pretty flat to me. So there's certainly valleys, peaks and valleys, mostly valleys, and those valleys are around between November and December when it's seasonally quiet and people aren't really applying to jobs. But 2021 in terms of candidate traffic of actively searching for jobs is quite flat year over year. The only, I would say, new activity that's kind of sticks out to me personally is at the beginning of this year, job seeker volume spiked quite a bit. So in the first week or two of January of this year, it's a lot higher than it has been in January of 22 or certainly in January 21. But if you were to take this same graph and zoom out not 2 years but 5 and capture up to COVID and pre-COVID, these job seeker search volumes would be a lot higher. So we're still actually quite depressed from job searches from 2-3 years ago. We're about 20% lower than we were two years ago. So job seekers are still searching certainly, but not as much as they were a few years ago. And again, I think the reason for that is most of them are employed. Most of the unemployment rate is pretty low, and so yeah, some people are certainly looking, but not at the levels that we saw in 2020 or 2019. 2021 and 2022 looked really similar to each other from our side across the sites that we power. And then, if you look more globally outside of our association sites, through Google, it's pretty consistent with what we see. And in terms of job postings, I decided to kind of go broad at first and look at data that the largest job board in the United States put out, Indeed, and kind of see what they were seeing, and kind of I'll give you some insight into how that compares to some of the industries that we operate in and work with our association partners in. So if you look at job postings on Indeed and kind of compare that to the baseline being January 2020, so just before the pandemic, or maybe it's February 2020, just before the pandemic, you'll see that the dip here on the left, that's the lockdowns, and then the recovery within the same year, and then a 2-year period or a year and a half period of just tremendous job growth on Indeed, and that's kind of what the whole recruitment advertising industry saw. And so what happened last year was that growth started to kind of peter off. It started to flatten, and then it started to decline a little bit. But we're still at really high levels. We're still at much higher than we were pre-pandemic. And so if you compared on Indeed, what they're seeing is year over year, job postings were down just about 8% across all industries. And so I'll talk about which ones, at least I handpicked a few relevant ones based on kind of the partners, types of partners that we work with. So keep in mind, this is all job postings. This includes retail, hourly workers. This includes high skill and low skill workers, kind of everyone across the board. So job posting volume is down a little bit year over year and declining. I think at a it's at a small pace across the industry. Um, and then what that's allowing to do is with some of that softening up a little bit and certain industries experiencing a larger slowdown than others. For example, software development is one of the industries that has been significantly impacted by layoffs. Their job postings, that, as I'll show you in a little bit here, dropped off much more than this 8%. But with that softening demand, there's also a softening of wage growth. So with this trend of job posting volume going up over the last nearly 2 years and at historic levels of competition for talent, that's driven employers to be more competitive with pay, benefits, and things like that. And it has significantly increased wage growth month over month over the last couple of years. What we've seen in the last 6 months, as some of these industries have started to either pull back or even lay off and reduce their workforce, is some of that wage growth actually reversing course, and wages are starting to actually go down a little bit, particularly in like software development, IT, and some of those kind of more typically positions that are much higher paid, and a lot of mostly concentrated in the high tech industry. But there's still plenty of other industries where wage growth continues to grow, and some industries where it's growing still pretty rapidly. In most, it's starting to flatten off, but in some, it's still growing because there's still just a lot of competition there. The other thing that the Bureau of Labor Statistics puts out is the 1 month net change of jobs, and 12 month. I'll do that on the next slide, but just to put it into perspective of how many new jobs were created, or the net new number of jobs in December compared to November. Healthcare for us, not for us, well, it is for us, but also, in the United States, continues to be a robust category. And so health and social work continues to grow rapidly. Leisure and hospitality is growing, although it's starting to slow down in terms of the job posting side and the wage side. And then there's certain industries that are pulling back, but not that much. So again, professional and business services, this is a lot of the high tech workers. Yes, there's been layoffs and it's pulled back, and it is negative, but the quantity is not that high just yet. But it is pulling back, and this is just for 1 month. If you look at a 12-month net change, so 2022 compared to 21, everything is up. So on the left is the same graph I just had in the previous slide, but on the right is a 12-month net change. So there's not a single category that BLS tracks where the net change in employment went negative. And so every industry is up, including professional and business services, where a lot of the high-tech talent falls into. But that has started to pull back, and it may be negative for some or all of this year. And so overall, last year was a very competitive year. There was all these signals of a recession coming for a lot of the year. And really what happened was it didn't impact the unemployment rate last year. It didn't catch up to it. And certain industries, yes, pulled back, and some industries are starting to pull back now or slow down hiring. But overall, there's still a lot of jobs looking to be filled by employers that don't have enough people to fill them. So I wanted to take the same data that Indeed put out and get into a few industries in particular where we operate in a lot with our association partners. And healthcare for us is a big one, and we work with a lot of healthcare-based associations. And this is a really broad vertical. Healthcare encompasses just a ton of different specialties, a ton of different job titles and roles. And so you'll have to take this with some grain of salt because there's pockets within this industry that are maybe higher than what I'm about to say, and some are lower. It just depends. But the industry as a whole had, again, tremendous growth post-COVID. So this blue line represents, healthcare as a broad industry across all the job titles. It kind of peaked at the end of 2021 in terms of growth, and then started to pull back just a little bit by the end of last year. And so the industry as a whole is declining, but this includes just tons of job titles. If you start going into the specialties like nursing or physicians, or roles where there's continues to be a really strong labor shortage, those roles are still growing. So for example, this dark yellow line is physicians and surgeons. That you can see that compared to pre-COVID, it certainly dipped for a small period of time, but has been consistently growing and is not trending down in any way, and is likely to continue growing into this year. Nursing is growing. It was growing faster, and then it started to flatten out, but it's still growing at high single-digit percentage year over year. And so healthcare, our view is going to continue to grow. There is some specialties or some pockets of healthcare that are in a decline. None that we are seeing that are in a huge decline, however. From a leisure and hospitality, which is again another broad category standpoint, that's been a category that grew really quickly as well. It had the same kind of pattern last year, where it was that growth started to stall out compared to 2021, and still maintained really high levels of job volume. But that growth started to flatten out, and maybe a very slight pullback at the end of last year. And then certain pockets of this broad category ended up declining a little bit, but overall, I'd say this category, as the world opened back up and people started traveling, this category has been quite robust, continues to grow. This category experienced a lot of wage growth, and so if there is a little bit of softening of demand, I think that'll result in some of that wage growth starting to slow down. I don't think it's in this category is going to reverse itself, those gains, but I think that wage growth might slow down a little bit. But in the same moment as I'm saying that, I saw a story right before this that I guess Walmart is increasing their minimum wage for all of their employees from like $12 to $14 an hour, and now the average worker there is going to make, I think, $17 or $18 an hour. So I think that wage growth is going to continue as companies want to hire the best talent, and this category is a popular one for some of our association partners. And then there's this is a broad category that I tried to be quite specific on, of business services. And this is kind of a mixed bag that I can hopefully give a little bit of color to. So business services encompasses more than just these 5 or so I chose. But we have partners that that work in the fields of accounting, finance, legal, marketing, and software development. And depending on which of these specialties they operate in, the labor market looks pretty different. For example, if there's our association partners that are more in the marketing or the software development side, have seen a pretty substantial pullback in hiring demand from companies, and a lot of that is again, like I said, driven from the high-tech companies that grew really quickly. They had great, they had a high amounts of funding, and they started to grow very quickly to, knowing that there was another round of funding coming in a year or two, that drew wage growth and it grew headcount really quickly in their software developers and their marketing departments to get more business. But as interest rates went up, the access to capital and the cost of debt also went up, and many of these funded companies that were burning cash realized that they needed to stretch this cash a lot longer and maybe wait several more years for that next funding round, when they might have expected it within months and not years. And so that's what's resulted in a lot of the pullback that you're seeing. It is is companies, either funded companies that are looking to have a longer runway, and they're pulling back on marketing in particular and in software development, both very high paying jobs, or software companies that are not funded, that are well established, like Salesforce and Google and Amazon, that are pulling back because of the economic uncertainty. And most of them will say that they overhired, thinking that the economy was going to continue to grow. They're concerned that it's going to pull back, and they want to make sure they can kind of weather any kind of potential storm. And unfortunately, these two types of jobs have suffered quite a bit from that. There's been a significant pullback. We're still actually a lot higher than pre-COVID levels, but there has been a significant amount of layoffs there. But across the whole recruitment advertising industry, it doesn't register too much, doesn't make a huge impact. But within business services, things like accounting, legal, those continue to be quite robust and growing. And so it just depends within this sector. Depends on exactly on which specialty and what kind of function the workers are serving. And then the other kind of vertical that we have a lot of partners in is the education, both schools and K through 12 and the higher ed. That continues to be a competitive industry that's growing very quickly, even all of last year. I think that's driven largely by there's historically been a labor shortage. It hasn't gotten any better. And in fact, surveys performed by the American Federation of Teachers in the middle of last year found that teachers were more likely to leave their profession in the next 2 years than before. And so I think this labor shortage is likely to continue. And so the job posting volume within that vertical has been growing steadily all of last year, and had even more tremendous growth in 2021. And so I think the long-term outlook here well into this year is gonna be very, very positive. So what does this all mean to employers, to the employers that want to hire and ultimately recruit your members? And what does it mean for your members and if they're a potential candidate? So there's still, there's still 4 million, a delta. There's still a gap, a 4 million gap between the number of open jobs and number of people looking for work. And so there's 10.5 million open job today, and 6 million people out of work. And so there's still a really big gap between supply and demand. That means employers are getting less people applying per job, or less qualified applicants. There's more competition to get those eyeballs on those job postings and job openings. They're spending more. And they're typically, like I said, that competition is driving wage growth in many industries. I would, in the early last year, I would have said is driving wage growth in every industry. That started to slow down in some, but still wage growth continues in many industries. And so I would still say it's very much a job seekers market, and it's still very competitive to hire, especially high skill, high talent labor, where unemployment in the high skill sectors is lower, even lower than the already very low national average. So couple predictions from my side for next year. I think that for the first 6 months of this year, I think it's going to be more of the same. So whatever we've been seeing in the back half of 2021, the last 6 months, I think we're going to see in the next 6 months. So if your association, career center, or your industry has been seeing a slight decline, or it's been flat, or a slight increase every single month, I think that's whatever that pattern was is just going to continue roughly for the next 6 months. Past that, it's really hard to predict. And that's primarily because it's unclear how much higher the interest rates are going to go. And if they go too high, we're not going to have this kind of soft landing, and we're not going to be able to avoid a recession where unemployment spikes significantly. But if it's gradual and the market stabilizes, then we might still see low unemployment, have a soft landing, interest rates are starting to come down. And so there is a possibility of this kind of soft landing where we won't have a significant spike in unemployment. I think most people are forecasting a weaker demand this year than last year. Like I said, certain industries are going to be impacted differently. And so, for example, in healthcare, we don't think there'll be a weaker demand, but if you're a marketing professional or a marketing association, there will likely be a lower demand for that level of talent. So that's something to watch. Is the interest rates and the Fed rate raising those? Many economists are predicting a recession in the back half of the year, and those predictions have changed every quarter. Many of the ones that I'm hearing now are predicting a mild recession where unemployment won't be impacted very much. So jury's really still out on how monetary policy is going to impact the back half of the year. And the other thing to watch really carefully is this prime age labor force participation rate. So we saw a really large drop during COVID, and it still hasn't recovered. It took a significant dip in September, October, November of last year. It edged up a little bit last month. So it'll be really important to watch that. If that doesn't start to recover, I think there's still going to be this big gap of between supply and demand in the labor market, and I think it'll be hard for employers to hire. But if this starts to recover, and it might become a little bit less competitive and harder for candidates and members to get jobs. And like I said, we experienced really rapid wage growth over the last couple of years. I think there's a lot of signs that that's going to moderate and slow down this year, and in a few rare cases, maybe in slightly reverse course. But I think wages will still continue to grow a little bit, but not nearly at the levels that we saw over the last 12 to 18 months. So I know a lot of you already are partners and work together. Some of you here are about to work with us. So feel free to reach out to me personally or your customer success manager. We'd love to talk to you about the different resources that we provide to you and your members, and kind of offer kind of a whole holistic solution of a whole career hub to you and your members. And especially during uncertain times, we want to make sure we're helping you serve your members and help them advance their career, because frankly, one of the top reasons they join an association is to advance their career, and we certainly want to be a big part of helping them do that and helping you enable them to do that. So that's mostly everything from me. Happy to open it up to any questions. And if not, we can sign off, and we'll certainly send everyone the recording. Just give it 1 or 2 minutes here for questions. All right. Don't see any trickling in. If anyone has anything after, feel free to reach out to me directly. My email is Alexey, Alexey at webscribble.com. Thanks very much for attending, and looking forward to talking to you about this again in about a quarter here. Thanks, everyone.